Good afternoon. I'm Courtney Hazley with the SEC's Small Business Advocacy Office, and it is my pleasure to be co-moderating today's discussion, Rethinking the Rulebook, ways to modernize the IPO process and reassessing the framework for how companies of all sizes access the public markets. Joining me as co-moderator is Ted Yu, Associate Director in the Division of Corporation Finance. One part of the SEC's three-part mission is facilitating capital formation, and historically, much of that capital has been raised in the public markets. And to paraphrase Chairman Atkins, these public markets remain the anchor of American capital formation. But trends have shifted over time in terms of where and how capital is being raised. Public company obligations have also evolved over time, and we've heard some stakeholders raise concerns about whether or not the public company framework is perhaps burdensome or outdated. We've also heard stakeholders share their feedback that a robust disclosure framework is really essential to ensure that investors have the kind of information they need to make informed investment decisions. I think suffice it to say there's room for improvement, which is why I'm really thrilled that we're having this discussion and happy to be joined on the stage by these innovative and experienced professionals, and looking forward to picking your brains about exploring potential regulatory solutions to modernizing the IPO process and reassessing the public company framework and challenging conventional approaches. Ted and I are also going to be looking to get some of your feedback on some recent SEC proposed rule changes and interested in hearing particular pain points that you've been experiencing. So thank you so much for being here. Before we dive into the substance of our discussion, I think we should all have the panelists introduce themselves. So Dan, I'll start with you. If you could tell us who you are and how your work relates to IPOs and the public company framework.
Sure. Well, first of all, thank you for having me. This is great. My name is Dan Zinn. I'm the General Counsel and Chief of Staff at OTC Markets. We operate public trading markets for about 12,000 equity securities that are not otherwise listed on the New York Stock Exchange or NASDAQ or a national securities exchange, including many of the small companies that I think a lot of this discussion will center around, and that will benefit in large part from some of the changes you were alluding to in the introduction. So very excited to get this underway.
Happy to have you.
Ryan Mitness, a partner at Fenwick & West in the Public and Capital Markets Group. I represent public and late-stage private companies exploring going public in a broad range, but really focused on the biotech industry, which is a lot of relatively smaller going public companies that have kind of, I would say, some different needs and different obligations for what moves the needle for them versus maybe what the regulations set up for. So I'm really looking forward to the discussion to see things we can do to further improve them going forward.
I'm Jamie Klima, General Counsel of the New York Stock Exchange. Also provide leadership for our NYSE Institute, which advocates on behalf of our 2,400 listed companies, as well as promotes the long-term benefits of the capital markets and the strength of those capital markets.
My name is Josh Bonney. I am co-head of the capital markets practice at Simpson Thacher, which is a big Wall Street law firm. I've been at it for sort of 30 years, helping companies go public and be public, and I'm excited to be here. It's a fun fact, and my wife is an SEC alum, so she's also very excited that I'm here too. So, I have to thank you for giving me the opportunity.
And Bo Bohm, Global Co-Head of Equity Capital Markets for Cantor, which is the investment banking broker-dealer within the Cantor Fitzgerald group of companies. Have been on Wall Street in investment banking for over 25 years, the last 21 of which I've been focused on equity capital markets. So we do everything from late-stage private capital raising through IPOs, equity follow-ons, public market transactions, et cetera.
Great. Well, thank you. Let me echo Courtney's thank you for participating in this, and maybe we'll just get right into it. I did watch last year's roundtable, and I was just talking to Dan, and I'm so glad to be able to help out on this one because the SEC has been busy since last year. 3 proposing releases, among other things, registered offering reform, filer status, as well as semi-annual reporting. Let's just start with registered offering reform. It's ultimately about accessing capital, and one of the things that the proposal is aimed at is to encourage public companies to stay public by offering them the easier access to what is effectively cheaper capital in the public market. I'm going to turn to Ryan first, but I'd like to know from everybody what are the things that affect the public company's ability to use the shelf registration process and doing shelf takedowns? What are the factors? What are the regulatory rules that you have to consider? And also, what your thoughts are on the proposing release and addressing some of those concerns. So I'm going to turn to Ryan first and kick it off.
Thank you. And first of all, I want to thank the staff so much for these proposed rules in it. They are amazing starts and where we want to get going. Because I've just, like the registered offering reform, just a few thoughts I had initially and sort of where we are now before we get to there. If you're a smaller company and you go public, and you're going public because you want to access the capital markets and you want to do more follow-ons, you have several issues that arise right away. Okay, you get the IPO and you're public, but now it's 12 months until you can do the S3. So what can you do? You can do a follow-on S1, but that has this obligation where you're public for 2 days before you can price, so that takes a lot of use of it off the table because a lot of issuers just can't take that risk. So it almost becomes you're basically doing a PIPE, the private investment in the public equity, which works, and we do it all the time on it, but it also kind of defeats a little bit of the point and why we want to access the public markets. We also then have to deal with the 20% rules at the exchanges on if we're doing a private offering. And then the other another big benefit with the rule change was sort of moving the S3 forward, getting rid of the baby shelf limitations. Because right now we have these rules where if you're public float, which can be a lot smaller than your actual market cap for a lot of these companies, if your public float's less than 75 million, you're severely restricted in what you can do for financing, which effectively makes you back in the pipeline because you're not going to be able to raise 50, 60 million on it that you may need. So those two, making the S3 upfront and taking away the baby shelf rules, I think is going to have huge benefits to a lot of our companies in, frankly, being able to do a registered offering that they just couldn't do before. They were stuck in pipeline, basically. I think that's sort of a great benefit to a lot of these. Again, and then the sort of the WIC-C eligibility after 12 months, I think, is very useful. I'm kind of comfortable with that. I don't know if you need to have it right away up front because I can see the point for seasoning a little bit there. But just being able to have the short form registration statement, then you can then incorporate everything into and be ready to go quickly is going to be very significant for a lot of our clients going forward.
Do you think? How do you think a company that's looking to go public? How do you think the market practice will be that once they go effective on their IPO, that they immediately will throw up an S3, the way you throw up an S8, just because you can do it right away?
I suspect it will be upon the expiration of the lockup. That would be my assumption on market practice, because
Yeah, I mean, I could see as this, as things evolve going forward, and again, it's going to depend on the underwriters and the parties that are part of the lockup. I could certainly see a situation where you have carve-outs for filing of an S3 just to be able to get a shelf in place. You've got confidential submission that'll allow you to at least get the bones of the shelf filing and the registration process in place to allow for the more seamless capital raising post IPO. It's definitely the point you made around not having to go to the pipe route from a practical standpoint. That is, I personally think this is one of the things that's one of the most game-changing aspects of this reform since the Jobs Act, in terms of just the practical implications to the equity capital markets. It's when you're dealing off of for an S1 filer a pipe in those first 12 months of being public, the discounts that you're getting back from investors, are often incredibly onerous. And, part of that is that they have to take 30 to 60 days of illiquidity risk. And, post-IPO issuers are often, these aren't the most seasoned issuers in the markets. You don't necessarily have normalized liquidity, technicals to really support, a tighter discount. And sometimes, for some of these companies, you're looking at discounts in excess of 30% in a pipe, where if you had freely tradable registered shares to offer investors, you might be looking at discounts that are closer to 10, 12%. So it's, I think from that standpoint, incredibly game-changing and very helpful for companies to be able take advantage of this. But yeah, to your point, probably from a practical standpoint, after the IPO lockup, but we see a lot of early lockup releases, and I think you'll be able to see, companies be able to navigate that depending on how the IPOs perform in the aftermarket, be able to take advantage of those, S3 registrations much sooner than 180 days.
I think people will throw up the S3 because, well, certainly in sort of sponsor-backed IPOs, the IPO is just sort of the starting point. They want to sort of, monetize their investment in the company and sort of increase the float. And I think the idea of sort of separating, getting the sort of the mechanism to access the market separated, from a signaling standpoint to when you're actually accessing the market, I think will be appealing to people. And I don't think that, once it doesn't have a signaling impact, I don't think there'll be kind of concerns from sort of accepting it out from the underwriters lockups in the same way that S8s are. So I actually am optimistic. I think the whole idea of sort of like broadening S3, making it, available to everyone right away, and sort of, ASR sort of more broadly available to everyone after the seasoning period, I think is like, a fantastic idea. One thing though that I wanted to sort of like just toss out there as a different idea, if you want to sort of like take that one to 11, is, every registered offering carries friction no matter what we do. We can kind of like remove sort of the fulcrum of sort of SEC review. I mean, it kind of, if you think about kind of what we're doing here, it's sort of like you'll have sort of full SEC review on the entry into the system at the time of the IPO and then on an ongoing basis. But if everybody has an S3, you won't have sort of transactional based reviews. So it's a huge, it's kind of like crabbing a little sideways towards like company registration a little bit. But, another thing that, is kind of the way it works in almost every other country that I think, the SEC could do if it wanted to, is sort of explore whether we could sort of create an exemption for at-the-market offerings, under sort of 482 on the basis it's on a public offering. And so to the extent that, and I think there's ideas about how you could do that. We could impose seasoning, we could impose absolute volume limits, we could impose sort of like, transactional requirements that are maybe the reverse of 10b-18 or look to 144 in terms of the manner of sale and volume. But just think about how transformative it would be for the treasurer at a company to be able to sort of like, call up, a broker and say, sell $5 million of shares because I, to help me make payroll, without having to have all of the friction of, the lawyers and the underwriters and it's a lot, even with the S3. And so, and if you think about it from a policy standpoint, if you constructed the exemption, the right way, the buyer, they don't even know who they're buying from. There's no marketing. There's no special selling efforts. It's a little unclear actually, what benefit sort of the application of registration under the 33 Act is actually like providing, other than creating friction.
Right.
So it's an idea.
No, it's an interesting idea. And at the market offering is going to be a huge, quite a bit of change. And I could just see Dan, many of your constituents will have views on this. So what are your thoughts on it?
I was thinking about diving into the middle to start talking. I was getting too excited. But yes, and first I want to echo the sentiment of what I think everybody else said, at least in terms of the impact of what these rules can do. The expansion in our market in particular, where for the first time you have access to these kinds of S3 offerings. You have access to an at-the-market offering specific to our top two markets, OTCQX and OTCQB. That is a game changer for exactly the reasons that Josh was talking about, the friction that exists. And you guys were talking about the pipe world and the kinds of discounts you see there. We talk about it in our world as debt spiral financings, right? Where it's an entrepreneur or it's a founder who just needs to get that next round of financing in to make their idea work, and they'll take a deal that is a convertible financing that's going to convert at some significant discount to the then existing market price. And as soon as that converts, you're going to see everybody selling into the market, you're going to see the stock price go down, existing investors get harmed, et cetera. Sometimes that was the best or the only option. Now you're going to have easy, relatively frictionless access, still on markets that promote the same kind of concerns that I think people raise around information availability and availability of market data and liquidity, right? Doing it on our OTCQX and OTCQB markets to support the small companies that all of these rules are designed to support. That is a game changer in a big way. And I have nothing but positive remarks to say about the S3 changes themselves in terms of the $75 million cap going away, the baby shelf rules going away, and even the timeliness, the 12-month waiting period. It impacts companies on our market who are really working as hard as they can to get that idea to take hold, and to have that financing concern alleviated even a little bit is a big move for them.
No. And Jamie, one thing that I want to throw out for you to comment on is you'll see that the commission is proposing to essentially move away from the WIC-C definition for domestic companies and really kind of leaning heavily on whether you're on an exchange or not. So how does this proposal look from your perspective?
I think it certainly makes sense, right? And we have a lot of initial listing standards. We have a lot of continued listing standards that maintain the status of the companies and their compliance therefrom. So I think it does. I think we have an expectation that there would be more shelf offerings. I think anything you can do in the space of making these sorts of accommodations available sooner and making them available for longer periods of time is certainly a real opportunity.
I'm kind of curious what this crowd thinks. The ELIs are the ones that are on exchange listing on an exchange, and then we have the CLI. And by the way, if you have a different view of how to pronounce it, please let me know. Endless debates inside the building. And the CLIs essentially are ELIs, but after a year, you get to go automatic effective registration statement. Can I get a sense from the group how much that distinction is needed? I know is automatic shelf registration statement so important that we need to sort of hold it in check until you report it for a year, or do you think it really isn't a distinction that
I
needs?
think it goes a little bit to your question about whether people got to toss the lot. I mean, if you just sort of think about if a company's just gone through a full review in connection with its IPO, I can't imagine it's going to be like a good use of staff resources to review the S3 that they just file. And so if everybody does that, they're going to have a shelf that'll carry them certainly, for the first year anyway. So I guess the real question is what are we getting by sort of like withholding the automatic effectiveness? I mean, I see the logic of it just because we have this seasoning concept and going to get abandoning it, but it's not entirely clear to me how likely it is that you guys are going to be reviewing those S3s anyway.
Got it.
I don't want to derail it, but I will push back on it a little bit to the same, kind of in the same vein. What is the purpose of making this distinction of exchange listed versus not exchange listed in this context? The point around disclosure, and really a lot of what these rules are doing is broadening the look to say if you are an SEC reporting company and you're making this impactful information available to the market, that's what we're concerned about, and that's what we want investors to have access to. So once you've hit that mark, absolutely, this is why they didn't sit Jamie and I next to each other. Absolutely have listing standards and rules that kind of help investors and others understand the type of company that's on each level of market, et cetera. But the baseline disclosure for the New York Stock Exchange or NASDAQ or an SEC registered company on the OTC market is really the same. And so, I would push a little bit more to see access even to just the ELI, or I was calling it the ELI, but the ELI, alleviation of some of the restrictions apply to an even broader set of companies.
So shifting gears just a little bit, one of the other parts of the proposal is really kind of an expansion of the ability of research analysts to cover companies that just enter the market, because when you start fiddling with the S3 primary eligibility standards, it sort of nicely flows into existing rules. So maybe I'll turn to Bo. What do you think in terms of the proposal and its impact on research analyst coverage, and how meaningful do you think it'll be?
So I don't know that what's in the the proposal today necessarily impacts one way or another how the research analysts will do their jobs and the impact of research. I mean, I would like to see, and I know there's we've had some conversations around what are other ways to potentially change how the IPO process to allow for better utilization of the research analyst. We have obviously there was a period of time where the research analyst had a much more direct impact on IPO execution, investor education. We see this, with, when we're doing European listed IPOs, we see a much more significant impact of the research analyst in terms of their role in pre-deal investor education, pre-deal research, and really utilizing the knowledge base they have about a particular sector, a particular company, the comparables that are out there, and to be effectively the smartest person in the room as it relates to the underwriting syndicate, and to be able to use that that person to get out and educate the investors. We're talking about a little bit beforehand around for smaller companies, the ability to put out forecasts. And, if you don't want to go to that extreme, the other way to effectively achieve that is to allow the research analyst as part of the testing the waters process, not waiting until, the IPO roadshow when they can actually be doing, investor education, but much earlier in the process to take a more significant role in valuation discovery. For me, I think that is the biggest pain point for smaller companies that are contemplating doing a traditional IPO. And I think this was a big part of the reason we saw so many companies in 2020-21 pivot to doing SPAC offerings, because of the ability to have that forecast model out there and to be able to raise capital and get commitments from institutional investors at the beginning of their process before they go through this exhaustive SEC process and to get on file. And the traditional IPO process is effectively an inverse of the de-SPAC process. And the biggest pain point for a lot of these smaller companies, I took a company public earlier this year that on a trailing basis, they do about 25 million of EBITDA. It's about a $500 million market cap at the IPO. For that company, with that type of cash flow profile to commit to a 6, 8, 10 month process of going public, and $5-7 million of cost, and to not know until they get to the point of their IPO roadshow what an investor truly thinks about valuation. But that's taking a significant leap of faith, and it's only we can only get so much from the current testing the waters process. Most investors, you take them, you do a couple of waves of TTW meetings, with those investors. They're playing option value at that point. 9 times out of 10, they're going to come back and say, "Oh my God, I love it. Great story. Love the management team. Definitely interested. Make sure I get a look when you watch the roadshow." And then you watch the roadshow, and they could be scratching their heads and saying, "Well, yeah, I don't know about the valuation." And so I would love to see some expansion of what's being put in place to allow for. And again, I'm not advocating that we put research analysts back in the room with management teams to go on the road and go back to the 1999 way of taking companies public, but to really, to allow them to have a much greater, more central role in that pre-deal TTW, investor education, whatever you want to call it, process that would allow us to then be able to go to those companies much earlier in the process and say, this is what the valuation framework is looking like. Not just because we, the investment bankers, are telling you that we think that it's this, but this is what all the investors are coming back with in terms of that feedback.
I know, that's a good point. Yeah, and I know, sorry, Ryan. Yeah.
Oh, go ahead, Ryan. No.
I was going to say, kind of lean on that. I mean, it is interesting to seeing the process on the legal side, watching the banker process play out. You see, we have Analyst Day, and the company presents to the analysts and all that. But completely separate, they're doing all the TTW outreach. And it's like, there's got to be a way to connect that because they're getting, the investors, they're fine. Oh yeah, no, we love it. Then, the market's a little softer than we were 6 months ago when we talked. And so you hear a lot of that. And then you have the analysts, and very comprehensive Analyst Day presentation, and the analysts get a lot of information to go ahead and build their models that nobody can see till a month after we've priced the IPO. There's definitely a disconnect there. I do think there's some way we can integrate that a little bit more without going back to some of the problems that occurred in the past.
In our markets, and again, I don't want to derail it too much, but the concept of research for these small companies is a huge part of the discussion, has been for a very long time. One of the things that this proposed rule does is dip its toe into preemption at the offering stage, which is great, and I think very helpful. We can get into that. as this session goes along. Another aspect of that as it relates to research, particularly in OTC traded companies, is these state laws impact what a broker can recommend and where they can distribute research. So if you are a national research provider like a Raymond James, and even though we've done a great job of getting 41 states and jurisdictions to give exemptions to our OTCQX market, right, getting a national agreement is nearly impossible. We've been at this for about a decade. Seeing preemption extend to secondary trading so that it would allow brokers to do things like distribute research nationally would provide some of that back end coverage that these small companies really struggle to gain. So that's it. Josh talked before about turning it to an 11. That's a way to turn this to an 11 on the preemption side.
Well, I think just and maybe just another kind of somewhat extension of that. I mean, I think the other thing that would be very helpful, and there have been some changes, around post-IPO, quiet periods and when analysts can initiate. In practice, this is still, we're dealing with 25 days post-IPO until analysts can initiate research coverage. And again, these are the folks who are supposed to be the foremost experts out there in terms of educating the broader market, not just the IPO investors, not just the institutions that got, one-on-ones and were able to do investor education calls, during the roadshow, but all investors. And I think when we have 25 days before they can actually initiate in the aftermarket, it's hurting a lot of retail investors that don't get access to the IPO. They're buying it in the days post-IPO. You've got a very finite period post-IPO where you have a reasonable amount of trading liquidity before these things, volumes tend to dry up a little bit. Trading can get a little bit more erratic. I think it would be helpful to have, the ability to have analysts initiate and get their models, their reports, and their valuation views out more broadly into the market post-IPO.
Uh-huh. And Josh, you had a comment. That's
Yeah, I mean, my sort of, in some ways, I think we should clearly sweep aside any sort of regulatory impediments. I think that the Commission's actually already tried to do that. And so a little bit, you're kind of like pushing on the string, right? Because there actually, I think, is more flexibility, in an IPO context for people to sort of put research out, right away, and then they're just not availing themselves of it because of sort of, liability management concerns. But I do think that focusing in, I mean, if you think about how companies are valued, right? I mean, the most important of information is sort of the forward-looking sort of earnings, right? I mean, that is the most important thing. And if you look at sort of the package of information that's actually formally communicated in our process, that's not there, right? And it doesn't work that way in other countries. In other countries, actually, you're required to potentially have forecasts. And so, you might say, well, how does our IPO market even work then? I mean, we have kind of a Rube Goldberg contraption that, nobody would design from scratch. The only real benefit of it is that it works, and the way it works is that, the company educates the analysts and the underwriting syndicate. They get smart on the company. They have the company's forecast. They form their own views. And even though they don't put the research out until 25 days after, they do communicate it to the big institutional accounts. And so the retail investor doesn't get it, but they're sort of price takers from the pricing that the institutional investors sort of negotiate with the company. And so it kind of works. But, if you sort of think about it, it works for companies that kind of can attract underwriting syndicates of the big banks and the analysts that are kind of willing to focus on it, investors that are willing to do the institutional investors that are willing to do their work. And so I do think that it is sort of an impediment for the smaller companies to sort of get the investor education that's needed, and so I do wonder whether there are things that we could do, in addition to sort of sweeping away and encouraging sort of more involvement, and earlier involvement of the analyst community, if we just sort of again, look, think outside the box and figure out if there's a way for sort of, these companies to communicate directly with investors. And the reason they don't do it is because of liability concerns, right? I mean, that's the reality. I mean, there's nothing in the SEC rules that actually stops people from putting, forecasts into their registration statement. Nobody's going to stick it in a Section 11 document, and I doubt that anybody is going to put it in a 12A2 document. Mm-hmm. But I wonder whether the SEC could promulgate a regulation that basically says, in connection with, whatever, if a company, puts out a forecast, prepared in and accompanied by appropriate health legends, maybe borrowing from the Private Securities Litigation Reform Act concepts, that it wouldn't constitute, a prospectus. And, maybe we could even sort of, when we're thinking about, defining sort of materiality for purposes of some of the other things that we're going to talk about, maybe there's things there that could sort of get people sort of comfortable that effectively, if they put good faith forecasts out there, that it isn't something that's going to sort of like, hang them by the neck if for some reason they're unfortunate in terms of meeting those expectations.
Right. And we're going to talk about forward-looking information a little bit later, but I definitely want to make sure we cover the other two SEC proposals. So I'm going to turn it back to Courtney.
Perfect. So pivoting a little bit, public company filer categories, like filer status definitions, these can have a significant impact on a company's compliance obligations and their cost structure. And we've heard calls over the years to recalibrate or re-examine those filer status definitions and categories. We've also heard interest or concerns or questions over the current Exchange Act reporting cadence and whether that cadence for interim reporting hits the right balance between transparency and operational burden. And so, as you all know, and as Ted alluded to earlier, right, the SEC recently proposed to simplify filer status definitions. And if that proposal were to be adopted as proposed, you'd have about 80% of current public companies who would fall into this category of non-accelerated filers and who would benefit from enhanced accommodations. And the SEC has also proposed to permit companies to opt into a semi-annual reporting scheme rather than quarterly reporting. So with that in mind, I've got a pretty heavy two-part question for you all to consider. So to what extent do you think the filer status definitions themselves influence a company's appetite for going public or staying public? I think those categories are right-sized. And you can talk about right-sizing either as like they're currently in play or as proposed. And then I guess the second part here is, from your vantage point, to what extent is a company considering interim reporting or the reporting cadence when it determines, do I want to be a public company? Do I want to stay public? How is it impacting my ability to raise capital or communicate with investors, that sort of thing? Yeah. Dan is nodding.
All right,
Kick it off,
I'm ready. I think the kind of connective tissue between those ideas is a lot of what we've been getting at in other contexts. It's a very commercial decision, at least in the smaller company context. So the determination as to whether to spend that money to go public and whether that's going to provide the appropriate return over time is a big piece of what makes this decision. So every opportunity to cut down on some of the friction, cut down on some of the cost, which these proposals would do, is an incentive to go public, an incentive to potentially stay public for longer, not have to get involved in some of the financings we were talking about earlier. So there's a lot that brings these things together in a positive way. I think, without getting into the specific changes as proposed, the idea of lowering these thresholds is the right idea. When it comes to the interim reporting cycles, we actually have a lot of context on this, because of the 12,000 companies that trade on our market, a vast number are non-US companies. They are listed on an exchange in their home country. They make their information available in English to US investors, and under 12G3-2B they trade here. Many of those non-US exchanges are already on a semi-annual cadence. And so there's a degree of what do we expect versus what is actually necessary that I think you need to consider. I also think that piece will be driven by commercial considerations. If you think that your investors or your ability to raise capital over time is going to be adversely impacted by pulling back and only reporting on a semi-annual basis, then you'll put out more information. You'll either keep the quarterly cadence or you'll elect a semi-annual cadence and provide additional quarterly information as you go. If, however, the cost-benefit analysis comes out that we're spending so much time and so many resources on this quarterly cycle, and we have, an internal team that focuses only on that, And eliminating that is going to open up the ability to run our business, to actually achieve what we want to achieve. Then that's going to be a compelling alternative. I think the way it's been proposed, that gives these options, that gives some certainty to investors as to what that cycle will be over time, being able to elect and then living by that for a little while, that's going to be the right way. And then when we do this again, Ted, you mentioned looking at last year's roundtable. Every year when we come back together, we can kind of review, and I really do think in 2-3 years, really not that far out, we'll have a really good sense of how the investment community is reacting, and that will, I think, make those commercial considerations kind of rote and easy to understand.
Okay, that's helpful. I'd love to keep on the topic of the interim reporting, Ryan, and ask you, I know Fenwick is conducting a survey on semi-annual reporting. I thought maybe you could tell us a little bit more about what that survey covers, what you're hearing from respondents, and also just what you're hearing from your own clients, because you have a pretty diverse client base operating in different industries, and I'm sure they have different perspectives on the matter.
Yeah, and so as of today, we have a little bit over 100 results so far of either currently public or looking to go public pretty soon companies. And it's an interesting mixed result. It really goes to the commercial point. I would say most are not deciding to go public or deciding to stay public based on quarterly reporting or semi-annual reporting. That's not really driving that decision. And whether or not they will adopt it, actually, right now, a majority of our respondents have said they wouldn't, but the reason is investor expectation, analyst expectation, competitor optics. So it's definitely a clear situation. Nobody's going to want to jump in and be first and be the only one doing semi-annual. It needs to be sort of, and we've seen some of the big pharma companies have kind of put out statements saying they're going to. Like, if that accepts up, I do think you'll see a lot more then take advantage of it. It's not, from what we've seen so far in the response, the cost isn't as intensive to take away 2 10Qs isn't worth it if the investors are upset, if it impacts their ability to raise capital. That's definitely going to drive it over everything else. There's going to be things to sort out on like blackout periods and when 10b5-1 plans, how they're going to work in there without having to all be sorted out with that. But it is clearly, I think the optionality is great, but it's going to be clearly a market-driven answer as to if this gets adopted.
It's interesting. Josh, what are you hearing from your clients?
Yeah, I think it's a lot of wait and see. I mean, my own sort of personal expectation, just from having looked at London, and how when they kind of switched actually from quarterly back to semi-annual, is that, most companies will probably continue to communicate to the market after the first and third quarters, whether, the market actually really cares about getting a full, periodic report, after those quarters. I don't know, probably not, but different companies, I actually think the idea of just sort of like, letting, the market decide and having different companies do different things is a good idea. And, over time, not every company does sort of like constantly raise equity capital in the public markets. And, maybe they'll get sort of comfortable saying, look, why don't we save a few bucks and not do the Qs? But I think we'll see. I think it is going to be people looking sideways and seeing what everyone else is doing.
I think it also, it depends on the sectors we're talking about and the types of companies.
Right.
If you're a pre-revenue biotech company, if you're a, mining exploration business, if there's nothing really to say on a quarter-to-quarter basis, and you can minimize, your blackout windows, and you can actually take advantage of the, ATMs, in that interim period, and then, yeah, I could see how it would make a lot of sense for more mature companies that use those quarterly announcements as catalysts for their own, earnings and communications with the market. They'll probably look to continue on, quarterly disclosure and, the way that it's been done before and how everybody else around them is doing it. But certainly makes a lot of sense, and it's very helpful for certain types of companies.
Yep, I agree with Bo. I think it will be sector by sector, and biotech is sort of the classic one we are hearing this with respect to. But I think there are also some practical hindrances here that may make it challenging, and it's going to take some time to work out. For instance, many companies have debt covenants or other contractual arrangements that may make it challenging for them to avail themselves until agreements can be renegotiated or otherwise. We've got certain sectors that themselves have different regulators on top of the SEC who have requirements that are embedded as quarterly banking public utilities, for example. So I think that's an opportunity for the commission to work alongside other regulators on these things to try and resolve. And again, to the extent that you've got, again, these debt covenants or otherwise that need to be amended, my understanding is, some law firms have been sort of getting in advance of this by building in some optionality that the covenants track what the reporting requirements are, as opposed to building in the word quarterly. But that seems to be quite diverse across the board.
Yeah, I would echo that with banking in particular. We have, I think, 600 plus community banks that trade with us, and we're starting to hear from them too. How is this going to play with my regular cadence of reporting anyway? I think that's probably true of even 8K style reporting. How many people want to put out information in a quarterly context versus more 8Ks and more of that current event reporting? So we'll see.
And I think, look, if there is under disclosure here, I think the market will work that out. To Josh's point, you will see the adjustment and the rule building in the optionality for 1 year to do one and then sort of change the flag to adjust in coming years. May also have real practical impacts here.
What about the other release that was part of this in terms of the filer status recalibration of definitions and really the opening up of some not insignificant accommodations to 80% public companies? Are there any thoughts on, the attractiveness of those changes, whether that's going to move the needle for a company that was considering going public but wasn't sure, and if that changes sort of what they're looking at in terms of the kinds of Exchange Act obligations they previously would have had to comply with that now might be off the table for a bit?
I'm happy to jump in there. I think one of the real heartening things that we saw there, and hopefully will portend for other commission rulemakings that are to come, is the executive compensation disclosure piece. So disclosure, isn't, we are not told that it is the driver of whether companies go public, but it's certainly meaningful and also with respect to staying public over time. And so the loosening up those executive compensation disclosures is really meaningful. And again, what our hope is that as time goes on and the commission considers the broader exec comp piece, some of these things will be opened up even more broadly to the 20% of companies that aren't going to sort of be accommodated here. I will say, as I look at overlap between what is in this proposal, pay versus performance, executive comp, and CEO pay ratio, those sort of being some of the components here, that all makes sense. Again, I think for the broader community, the one thing that I will say is not reflected in that list, and we hear about a lot from our issuers, is perquisites. And the idea that security disclosures here are tremendously meaningful in this threat environment that we have, and the scenario of continuing to disclose those things, again, for companies of any size, really can ramp up their threats further. The more you disclose, the more it becomes sort of a vicious cycle, if you will. So again, that is one component of this rulemaking that isn't there. But again, hopefully the commission is considering in the broader exec comp perspective.
I certainly think that in particular, the auditor attestation of the ICFR is like kind of basically taking that off the table for all new IPO companies for at least 5 years, and sort of taking it off the table for sort of 80% of the companies like forever, is meaningful because it's a big ticket item. It takes a lot of, not a lot of money, but also a lot of mind share of the CFO and the audit committee. And so anything that we can do to sort of like reduce, that burden on companies, and or at least focusing it on only the the way that you guys have thought about it. We get this much of the market cap with only this much of the companies. You know what I mean? I actually think that, makes sense. And I will endorse what you said about the comp, just because, to the extent that we have for sort of like 80% of the companies now essentially given them sort of SRC, EGC, comp requirements. It's not obvious to me like why we need to burden the other 20%. And in my sort of like lived experience, nobody cares about PEOs numbers 4 and 5 and sometimes 6 and 7, and nobody cares about any of the tables other than the SCT, you know what I mean? And so like all this additional stuff, I just don't know that the game is worth the candle from a cost benefit analysis in terms of actually providing information to investors that they actually consider to be material, and it's a tremendous amount of work. So I would encourage you, in addition to sort of fixing the things like treating the personal security expenses as a perquisite, just sort of looking about whether we could just sort of like cut the cord on sort of like holding on to the current regime for even the largest companies. It just, I just don't think it's worth it.
I'll just echo in on there. Yeah, the PVP disclosure, I would say, like, it's a tremendous amount of work. You have to hire outside vendors to even do it, and because the stock's volatile, like these things look crazy. Like you can't make sense of it. But it's very unclear as to what it is and what the value is, and it's pretty burdensome for very limited value. The other things, I agree with him. The auditor attestation piece by far is the biggest cost for companies, and when they think about the filer status and how companies are sitting there staring at the stock on June 30th. Are they going to go over 700 million, and now they got to pay another $1 million for attestation fees in the rest of the year? Is a problematic way to have to do it, because it's like, okay, oh crap, we went over by 1 million. Now we're incurring this. If I had this going in real time right now, where they're literally staring at their stock if they're going over it, and so one, just being a one-day stock price is problematic for lots of reasons on that. So that's a big improvement alone. And then just generally, like the complicated filer status as companies bounce around on it. I've also had a company that, in the course of 5 years, they went to WICSI, then they were smaller reporting, non-accelerated filer. Then because of revenue recognition issues, they became an accelerated filer, smaller reporting company, subject to 404B again. Now they're back as a smaller reporting company. Like that, it's a difficult way to run a business when like these are significant expenses that are coming in and out. So simplifying that to making broader gaps and a more phased period to go in, so you can time it and budget those fees a year in advance more clearly is very beneficial to clients.
Yeah, I would just pull that thread all the way through to our market as well in terms of the cost structure of particularly auditor attestation. And that's when I was talking about commercial concerns. It's what is the actual out-of-pocket cost that I'm going to incur here, and then the clarity piece of that too. What is my experience going to be as a public company? That the story you tell is really informative into what some of these companies, even if that's not their actual experience, the fact that they have to track it and understand that that might be what they have to deal with and budget for it, plan for it, it's a deterrent to everything that I think the commission is trying to achieve with these rulemakers.
Super helpful. Thank you guys for all that.
So that's what the commission has been doing the last year, but the commission's not done yet. So the chairman made it very clear the IPO process itself is now a focus for the staff and the commission as well. There has been some comments coming in, but frankly, not as many as we would have expected. Sorry, let me phrase that. It's early days, so we will get more. Sorry, that came out wrong. So returning to the IPO process, I'm interested in hearing from everybody. What about the IPO process today works well, and what doesn't work well? And maybe I'll just start with Bo and then just go down the road.
Yeah, I think, look, maybe I'll start on the, what I think where there could be tweaks. Talked about the research analyst, piece. I do think that is an important aspect of making sure that we have greater clarity around valuation much sooner in the process. I think the overall timetable is still it's still a pain point for most issuers. I don't know that I mean, candidly, I don't think the SEC response period is the issue. I think 30 days for first round comments. I think there's plenty enough that we, as underwriters and with the issuer and all the other work streams as part of the IPO process, that we can be doing over that period of time. I don't think that's the issue. I do think that there are some unnecessary delays embedded in the process. One of the things I think that's a very easy fix is the 15-day waiting period between public flip and launching an IPO. I don't know that you necessarily gain as, an investor, whether you're institutional, retail. I don't know that you necessarily gain very much over the course of those 2 weeks or 15 days. I think you're subjecting a lot of companies who, keep in mind, have already, put forth the expense of preparing for an IPO. They've spent months getting on file, iterating with the SEC examiner, going through, multiple amendments, going through their testing the waters. You're doing all this, and then you're basically saying, okay, you're ready to go. No more comments. Flip your document public, and now sit around and wait 2 weeks. And we've seen these markets are very turbulent. A lot can happen over a 2-week period of time. I think that is, I think that can be shortened or even just outright eliminated. But I think in terms of, the overall process, again, whatever we can do, we've talked a lot about how to reduce costs. I think everything that's been put forth, in the spirit of reducing costs for issuers is a massive step in the right direction. I think it's really just, what else can we do to just get to greater execution certainty for these companies? It's not that big of a deal if you're SpaceX or if you're OpenAI, and, your deal's going to get done. But if you're, a small cap company that has, $5-10 million of EBITDA, and you want to go public with a $50-75 million IPO, the idea that you might not get there after 8-10 months of work is really, really daunting.
I think in that vein, one of the things that I think it's sort of like, to me, it's like the 404B of the pre-IPO thing is the PCAOB uplift. Without any exception, in my lived experience, the longest and most burdensome pole in the tent is sort of getting your SEC compliant financial statements together. And this is frequently for companies that have raised a lot of capital, borrowed a lot of money with AICPA financial statements. Does it have to be that way? If you sort of think about it, the audit standards that are now applying when you get the PCAOB standards involved, it's basically like a re-audit. It's like different materiality thresholds, different documentation requirements. It's just, it's a lot. And it takes a long time, and it costs a lot of money.
Yeah.
Do all of the incremental sort of public company, accounting standards, they have to be so different? Because it's problematic for companies that have sort of adopted private company accounting as they were permitted to do, raised a lot of money, obviously it was good enough for investors to, provide them the information that they needed. And now all of a sudden it's just months and months and months of work there, and then on top of that, occasionally you have problems where, you have a reputable accounting firm that's performing the audit under AICPA standards, all of a sudden has independence issues. That's incredibly expensive and disruptive for a company to have to, switch auditors. And so I wonder whether there are things that we could do to sort of to just look at that process and figure out whether we need all of it. Because I actually suspect that there's quite a lot of the PCAOB sort of transformation that has to occur that is probably, not necessary. And that would, if you think about sort of the 6 to 8 months of work, if you could shorten that and reduce the cost of it significantly, I think it would be really appealing to sort of attract, companies into the IPO system. Other things from an IPO process standpoint, I don't think it probably causes companies to shy away from pursuing an IPO, but it is a constant source, I think, of annoyance, the publicity rules. I don't know if you wanted to cover those later.
Everything's fair game.
Yeah, so I think that we have, as you know, but maybe the audience doesn't know, a safe harbor today that essentially says communications that don't refer to an IPO that are made more than 30 days before the public filing, they don't constitute, impermissible gun jumping. And I wonder whether, that 30-day before the public filing thing is really even needed. Could we just have a general exemption that basically says, communications that don't refer to the IPO aren't an offer? I know it would be, that would be kind of fairly transformational, into the extent it's sort of viewed as sort of moving away from the idea that sort of communications that condition the public mind are offers. But the reality is, given the environment that we live in today, with all the communication and all the ways that we communicate with investors, and including ways that the SEC is sort of encouraged, I just wonder whether sort of like cutting the cord on the idea that the widow or the orphan takes the prospectus and kind of sits in a quiet room and reads it without being bombarded with other things is really needed, and is the more important thing that they get the access to the registration statement. That is the comprehensive disclosure document, and that we sort of just make sure that otherwise they're not getting selling documents that are sort of not subject to liability. If that kind of thing is appealing, the other things that I kind of wonder about are we have sort of today sort of filing requirements that allow written communications that constitute roadshows don't have to be filed, subject to the condition that, a bona fide electronic roadshow is made available to investors. I mean, I wonder whether that could be extended really to sort of all other communications. I mean, why do we really have to file these things? You know what I mean? Isn't, again, the most important thing that they sort of like, are given to people also with the registration statement? And, in that spirit, I wonder whether the legends that are required to go on these free writing prospectuses can be just significantly shortened and just sort of cross-refer them to the registration statement. That would sort of facilitate the use of social media and other kinds of ways that people like to communicate. And I really just don't think with any meaningful, downgrade in investor protection, because the ultimate guarantor there is the quality of the registration statement.
So I agree with what these gentlemen have said now, but what we've been talking about through the conversation thus far about possible ways to improve the IPO process, testing the waters, letting companies go more quickly after confidential filings, and, gaining research coverage, again, in the very short period of time after the IPO when a company needs liquidity the most. So those are all really important things. But I don't want to lose the perspective here that a lot of what drives these decisions is not the cost of going public, but really is the cost of continuing to be public. And so that's where, really appreciate all the commission is doing right now to look at the longer term, disclosure obligations, litigation reform, all of these various pieces that fit together in terms of longer term burdens.
Yeah, I mean, I was just going to kind of jump on. It's kind of a couple points you guys are putting together there. Not only it's like that the 30-day period before you public flip, but it's effectively, okay, we need to stop talking about this when we're 40, at least we think we might price within 45 days, kind of 30 plus 15, which is impossible to figure out in this market. Like, couldn't you it ends up being 3 or 4 months that now you're in a quiet period, not able to talk, and it becomes extremely awkward for it. That's why I can, a couple of ways, I mean, I've been thinking about it, besides just removing the 30-day and sort of having, if you're not talking about the IPO and you haven't flip public, it should be okay. But also, if whatever you're putting out is materially covered in the registration statement and you're not talking about the IPO, that does seem like ordinary course. And you have companies that are putting out, they might have significant news because significant news is happening. We're entering into a major agreement. We have to put that out. And then it's always a dance with the lawyers, like, what can we say in here? We true, is it ordinary course? What have we done before on it? And it's frustrating for clients every time because it's just sort of like this black box for the lawyers to bless or not what we want to put in this press release. And so a much more clear way where if we're talking about something that's going to be in the registration statement, we're talking about something that's clearly ordinary, we're not talking about the IPO at all, it needs to be sort of a cleaner way to do it. For similar like the social media posts. Like, when all of a sudden the companies now stop doing social media after they've been doing it for a long time, that's kind of saying something already, even if you haven't said anything publicly. So just a few ways to sort of think about ways you can fix those rules going forward.
I mostly just want to clap for my fellow panelists, for they covered so much ground there. But in particular, to pick up on the point that Jamie was making, because I really think about this mostly in the context of ongoing secondary markets. So yes, all of the ideas expressed around IPOs have the same theme, right? How do you make this more clearly understood? How do you make this more consumable for a small company? But there's so much in it for what happens after that IPO. I was going to say, I would just remove the focus from the IPO. It's an important process, and it's something that there's kind of a legal banking industrial complex that has that down to a science with all of these potential improvements involved. but things like a direct listing or what would just typically be a Form 10, joining our market, otherwise going through the process of having your shares, a legend from a private offering removed and having your shares available for public trading. All of those are ways to access the public market and then reap the benefits of being a public company, a lot of which is what we're talking about here when it comes to secondary capital raising, investor interaction, right? Building your business, all of those things. I think the IPO is great. I think most of what the commission has done in these rule proposals that's focused on ongoing public trading is going to be what impacts this, or impacts the smaller companies at least, most of all.
Yeah, I do think, and I know we're going to get into alternative listing options, just on the point of, because one of the things, we're talking about all the amazing things that, that impacts that this is going to have on spurring more issuance, more small cap issuers. And, I do think we need to be a little bit careful about applying the same treatment post public listing across the board for, whether it's for IPOs, direct listings. I do think there's a little bit of, because if you play out, what could go wrong? With an IPO, you do have, you have a bona fide offering. There's a process. You're going to institutional investors. You're getting some degree of, investors, giving credit to, here, this is what we think is a fair valuation. This is going to trade in the public markets. If you're a retail investor, you're coming in, in many cases behind those institutional investors, and to have that layer of support and, accreditation of the offering is, I think, is important. With applying this just uniformly across the board for any company that, okay, well, I don't have to necessarily go raise capital from the institutional community. I can just do a direct listing. I don't have to worry about, baby shelf restrictions. I'll put an S3 up right away. I'll put an ATM up right away. And my fear is that, how this plays out in the market, you get back into like 30 years ago, a lot of the pump and dump, type of, issues that, that we had seen. And you have that issue where, any company can effectively just list out in the market, throw up an ATM, unlimited capacity. And if they catch a big retail bid, they issue $1 billion into the capital markets, and then the stock declines 50%, and it's the retail investors that end up getting really severely hurt. And so I do, and I don't have a solution for it.
Right.
And again, everything that's been proposed is a step in the right direction. I do think we need to be a little bit mindful of what could go wrong, around, that level of access into the capital markets for effectively just anyone who wants to go out and list.
Right. I think some of it is tied to what Josh was saying earlier, that none of this is an initial offering unless it's an IPO. So it's gone to a set of private investors, right? There are shares out there in the market. So kind of to your point around disclosure, if there's a group of investors that have agreed that this is a price that makes sense, you're already starting with that baseline. So it's not a full kind of open kimono, open book for that sort of thing. And then for most of what the secondary trading market provides, for all of the provisions we've been talking about with respect to public float or market cap, because there's so much value placed on what the market decides. How do retail and institutional investors, when they're all involved together in the market, price something? Over the course of time, the market usually gets it right. So having that, in the ATM context, for example, right, having that market price be the driver, sometimes it will help when a company's valuation is getting too overheated, right? And they can sell in, and it sort of rationalizes that price because there's a certain degree of interest. And instead of driving that price up irrationally, you actually see it spread out over the number of investors who get involved. So I agree, there's always a concern, and that's even why, when we talk about disclosure requirements, while I do think an Exchange Act reporting company is a reporting company, whether they're listed on an exchange or whether they're OTC, things like limiting some of these provisions to our OTCQX and OTCQB markets make sense because there are understood rules and provisions. And operations of those markets that investors can rely on. So it does help rationalize some of that. I think the commission, to your point, is working in the right direction to help solve these problems, and some of it will be borne out over time.
So one of the things that we talked a little bit before the roundtable was just the idea of forward-looking information. And I kind of want to dig into a little bit, because what we often hear is that is fundamentally a key piece of information that investors in the market want, but yet there is no, and while there's no SEC rule that prohibits the inclusion of that information, you don't find it in an IPO prospectus. And I know it's liability, but I know, Josh, you and I talked a little bit about it, so maybe you could tell us sort of the tension there, and also sort of what can the commission do on this front? There's been ideas discussed, but kind of curious what your and everybody else's thoughts are on this issue.
Yeah, I mean, I'm going to repeat the analogy, because at least our traditional IPO process is kind of a Rube Goldberg contraption that works. The company's sort of views and expectations for its forward-looking earnings are shared with the analysts. The analysts digest that information. They're sort of, expert consumers of it. They form their own independent views, that are, influenced, of course, but, by the information they're getting from the company, but also informed by their own sort of, understanding of, the particular industry that they're covering. And those views do get sort of shared with institutional investors, who are the sort of the big clients of the organizations that they work for. And those investors will do their own work, but they're, effectively, they have indirectly sort of a view about what the company's sort of, expectations are for itself. And so, the price discovery process, there's sort of the book build process of a traditional IPO sort of works to sort of like allow those, investors to sort of basically drive the ultimate pricing. And then, as, we mentioned, your typical retail layout, 15, 20%, whatever the max, we tend to, is, they're sort of price takers. They just follow along, but they're, the work has already been done, that they're not getting, fleeced. And so that's kind of works. And so the thing that I wouldn't want to have happen is to do anything which kind of like upsets the apple cart for something that isn't broken. Mm-hmm. And so to me, the real question is like, where are there sort of failures, and I think, potentially an area where we have a failure is the smaller cap companies, right? Because maybe the traditional IPO model isn't sort of working for them, and what are the things that we can do? I mean, unless Congress acts, I think it is unlikely that people are going to start sort of like putting forecasts into the Section 11 registration statement. I don't see a universe where that happens without congressional sort of like, safe harbor being created. But, there obviously are, companies are comfortable sort of giving their forecasts to investors in order to raise capital. They did it in SPACs, they do it, all the time in, private context. So it's not that they're just sort of like, unwilling to sort of like share with investors their sort of, expectations for their business. So the question then becomes, sort of like, are there things, from a liability standpoint that the SEC can do within its remit? And I do wonder whether there are sort of like pathways that we've done with other kinds of communications where we say, okay, this isn't a prospectus, that we might do here, conditioned on appropriate, guardrails around, accompanying, disclosures and things like that. That might allow smaller companies in particular to benefit. I don't know whether, every company would, take advantage of it. Maybe if they don't need to, then they might just prefer to, not take whatever incremental risk is still available. But, for smaller companies that really have no ability to otherwise sort of like, get the institutional investors the information that they need to sort of like, make that investment decision to invest in them, they might. I mean, it's an idea.
Interesting. Ryan, you represent many smaller companies, I bet, that are trying to go public. What are your thoughts?
Yeah, I mean, the big issue is the Section 11 liability is not going to go away anytime soon. Yeah. So that is just, there's really a fundamental piece. And I mean, sometimes you see people like maybe try to see what can we put in the roadshow deck as far as TAM and try to build out maybe a little bit, even if it's not enough numbers forecasts in there. We're trying to think of ways to give guidance in general terms without necessarily going into like having, because it's not going to be in the registration statement so much, we can't get materiality in here. So we're always trying to like kind of walk the line as what can we get comfortable saying as more like a general what our expectations are, and this is what the market looks like, this is where we think we would fit in it. And yeah, if there's more guidance to sort of be more permissive of things like that, is what can you say that is not going to be an offer in that sense, it's not going to be prospectus, and we could give a little bit more clarity to investors as to this is how we think about the company and the go forward, this is the commercial opportunity for the company going forward. Some more guidance on there, because right now it is most like, this is what we've seen work in the past, people have been okay with it, it's sort of where we are, and sort of that type of disclosure, because we're just not going to have forecasts in the registration statement.
But then again, this is where I think the understanding the limitations from from a Section 11 standpoint, that this is where the role of pre-deal research and the role of the research analysts can play a very significant part here. And whether it's in the underwriting syndicate or independent analysts, publishing pre-deal research, I mean, you could see an entire market developing just from that standpoint alone. But it's just, it's more information out there in the market for institutional investors, for retail investors. It's just cool. It's greater clarity. But it's exactly what we're talking about in terms of just that is the most important point in terms of how investors, analyze these deals, is just to have that information out there, and specifically, the forecasts. I mean, that's a major, blind spot for a lot of the market.
So we've been talking a bit about the traditional IPO process, but as we mentioned, there are other ways to go public. So I'm going to turn it back to Courtney to explore those other ways.
That's right. Bo hinted we would get here, and we have. So alternative pathways to going public, you know them, direct listings, SPACs, right? These have all expanded the menu of options for how you can become a public company. But they carry with them different liability expectations. We've touched upon that a little bit. I'd like to explore it more. Different disclosure practices, different market opening mechanics, and actually also different public perception. I'm also cognizant of the fact that, I guess, notwithstanding or any other regulatory updates, intermediaries like underwriters, exchanges, and certain investors, they play a role in determining whether any deal happens in the public markets and how it happens, and at what cost. And so with all of that in mind, I guess I'm curious to just hear a little bit more about your views on what's working with the alternate pathways that we've seen, and where are there still frictions or challenges that could be addressed to make things easier, to make those pathways improved. I don't know, Ryan, maybe
Sure.
some ideas here?
Yeah, sure. So it's very biotech space, because this year in particular, the IPO window is opened up, but there's small windows. They're open and they close quickly. And so I think Bo raised the point earlier, kind of the fundamental difference here is an IPO, you get your valuation at the end of the 6-month process, whereas if you do a SPAC, reverse merger type transaction, you get that valuation up front. Now, your stock's going to trade, that might not be it's going to be the valuation at closing, but you at least get a signed agreement with some type of valuation there. And that's a major benefit. And there's a little bit of more deal certainty in that versus the IPO. And on the biotech side, and interesting, it's not technically a SPAC, but it's very similar. I mean, you do this reverse merger where biotech goes public, trials don't work, it has limited operations now, so you just have like this fallen angel, and then it merges with another private biotech company. So it's effectively works the same way as a SPAC, it's just a company going in. One big issue that comes up there is due to more like some couple years ago SEC guidance, is that it's a lot easier now to classify those as quote shell companies. And so now we merge, you have this other company goes public by merging with this fallen angel, and now they're a former shell company for life. And there's a lot of restrictions that come up with there for really limited rationale as to why they should have the restrictions under 144 and all these other restrictions that apply just because they went public this way, which is a permissible way to go public. It's a very valid way to go, but it creates this weird overhang, even if the other company had operations, but they did a contingent value, right? So all the assets left, and then the new assets came in, and therefore for a moment in time they're a shell company. So they're subject to a shell company for life, and they're an ineligible issuer for 3 years. So it's, like, that is something I think that should be looked at a little bit more as to whether that really makes sense in that type of transaction. No.
You think you'd have a cure, like a disclosure-based cure for shell companies to get out of that treatment?
Right, and there's like, if you file the Form 10 information with like another year's seasoning period, what we have now, but there's still other restrictions that apply. But really, once you file the Form 10 information, how are you different from any who just did IPO? Like, that's the same sort of disclosure in that sense.
I thought you were going to take this question into some of the things that the SEC has done, and some of this is, my view of what it is to go public is not necessarily only exchange listing, right? So things like Regulation A, things like crowdfunding, even doing Reg D offerings that ultimately season and then go through a 144 process. And it's what I was getting at earlier about accessing the public markets through a number of these different mechanisms. All of those things should have been considered, should continue to be considered. I'd love to see some of the more recent rule proposals be more inclusive of Reg A going forward, because it's a really useful avenue that hits on a lot of the points we're making about cost and understanding what your obligations are going forward and still being able to access the public market, but you want to give that a little more boost as well. Those are the kinds of things I think about as alternative pathways in our markets. And then it goes to what I was saying before. That's really what I was getting at with, if you've done a Reg D and had investors that are involved and you have a market and now that's seasoned and now you're ready to have a public market, ensuring that you understand what that experience is going to be in the secondary market over time is a big piece of it.
I feel like Ryan hinted a little bit on some targeted rule updates that could help reduce execution risk for these alternate pathways, or maybe clarify disclosure obligations or certain liability frameworks. Any other targeted rule updates that you all have top of mind that the SEC could consider?
Does that have to be just about this?
Alternate
Can we
pathways.
just, we can go. I know we only have like 10 minutes, but
you should go rogue, sure.
Not to go rogue, but I do think considering there's a catch-22 that I think is somewhat being addressed by some of these rule proposals that looks at your liquidity metrics or your public float or your valuation as a measure of quality or as a measure of trustworthiness, while simultaneously limiting your ability to achieve some of those metrics, because if you haven't met that mark, and some of this is the ELI and CELI considerations, if you haven't met certain marks, you are then prevented from having access to some of the things that can help you meet those marks. So thinking about, you could apply this to alternative pathways, although it's broader than that as well. Thinking about how to democratize more access. Even the discussions that we were having around institutional investors leading the way for retail, that is very useful, but it's also only a piece of it, because thinking about democratizing access to all of that information to retail from the beginning and giving companies a pathway that allows them to kind of use those high leverage moments that we were talking about around, whether that's research or initial information provided by the company upon going public. Those are ways to allow particularly smaller companies to grow into what I think we all want to see them become.
All right. So can I ask a question? So direct listings, it was sort of a big thing when Spotify wanted to do it, and there was quite a bit of commentary about how that's just going to be the next way to go public. Are there any particular reason why it hasn't perhaps been used as much as folks initially thought? Is it an SEC regulatory issue? Is it a business issue? Is it, what kind of company you are and it just doesn't work? And it's better to go through the IPO process, the traditional process. Any thoughts as to how you would advise a client that wants to go public and sort of asked you, well, what about the direct listing? What would you advise them? How would you help them think through which path is better?
Happy to jump in.
Yeah.
First, I mean, look, I think the direct listing is a very viable path for certain types of companies. Like, it works for the Spotifys of the world. If you're a large issuer You don't particularly have a need for capital in an IPO. You have a diversified shareholder base already. You've done a lot of pre-IPO capital raising. You've already built up your institute. You've got Fidelity and Valley Gifford and all that. For a lot of those companies, it makes sense. I think the biggest issue with why it hasn't caught on much more broadly is a lot of the institutional investor community doesn't love it. Now, some of it is self-serving in terms of why they don't love it. You go public through an IPO, there's this notion of an IPO discount. You're raising capital. You have a company that has a $1 billion market cap. You're doing a $150 million IPO. If that company should trade, at a billion in the fully distributed, on a trading basis, then that deal should get offered to investors with an IPO discount. So maybe it's going to come public at an $850 million valuation, $900 million valuation. So if those investors in the IPO, they're incentivized to buy the IPO to create, that initial, liquidity in the market, to give the company its kind of, initial shareholder construction, what that looks like. For direct listings, the institutional community is not as incentivized in the same way, to come into those, to those deals in the very beginning. I think the other thing, and again, this going back to the Spotify analogy, and it's not the perfect solution for every company. Some companies need, they need the capital raising opportunity. They need, and again, whether or not it's an IPO or a de-SPAC, or a lot of companies going public, they're not the big mature, super cash flow generative, perfect leverage profile type of issuer. And so, and nobody's been really able to. I know there have been a lot of advances and, to allow for theoretically the notion of capital raising as part of a direct listing. We haven't seen it yet. So from a practical standpoint, and again, I think a lot of it has to do with, investors in that, discovery process. The other thing is, I think investors have pushed back on they like the idea of being sort of catered to, by the underwriters, and, you get the, testing the waters, and they get to spend a lot of time around these stories, and they really get to be part of that, valuation discovery exercise. And in the direct listing, it's a little bit of, let's see where it's trading in the public markets, and eventually over a period of 15, 20, 30 days, it'll sort of find its level. Institutional investors are just they're not part of the equation with that. And so they're a lot more, a lot of the feedback we've gotten from investors around direct listings is interesting. I'm going to watch it, let me see how it plays out over the course of the first month or two of trading, and then I'll decide, what I really feel about it. But again, I guess I just sum it up by saying it's a great path for certain types of companies. I do fear that, as I mentioned before, particularly with some of these changes, that it will be something that is taken advantage of by companies that really aren't ready for the public markets as a way to kind of gamify, let me get out into the public markets, and I can hope that Wall Street Bets picks up my, ticker, and some, roaring kitty starts talking about my company, and then all of a sudden I could be the next GameStop. I do worry about that.
I think one thing, just to emphasize, something Bo just said, I think is important, right? Essentially the companies that he described it works for are people that actually are companies that already have effectively like a public company style shareholder base, right? And that's very few private companies. So I think that's the real reason for the take up. If you don't have sort of all those names in your book already, the IPO process is the way to do it. And honestly, if you don't have a large shareholder base that wants liquidity, there's no way to do it either, because there's nobody to sell. So I think that's probably, look, who knows, they can predict the future, but I think it is unlikely to sort of displace the traditional IPO. But that doesn't mean that we shouldn't sort of work on improving the pathway and let a thousand flowers bloom. But I don't think it should be viewed as sort of a a regulatory failure that it hasn't sort of taken off. I think there's a lot of sort of just like market construct and dynamic issues that are there, not just the regulatory scheme.
Yep, and I'll echo what both these gentlemen just said. New York Stock Exchange was proud to be an innovator on the direct listings and their direct listings with a capital raise. And I think there's been some real disappointment after working that through with the commission and a lot of our prospects to put those things on the book. So we'll defer to sort of the bankers, the lawyers here on the panel as to why that hasn't gotten take up. But we at the exchange would be delighted if it did get more of that.
Yeah, another thing we're kind of repeating what I said, but I was like, the obvious thing most of these companies really do need is significant financing. And so that's sort of the fray that makes the direct listing makes a little less sense. And the other thing, besides you have to build your investor base, you need to build your banker research coverage base. So you need to have you want to have several banks on the cover. It's trickier to do with the direct listing fees on there. So I think all those sort of work in harmony to make it works for some companies, as noted. Obviously, it works for some companies, but for especially a lot of the smaller companies, it's just not going to necessarily be as useful unless sort of like a direct listing immediately followed by some financing, which does create some risks there.
Yeah, and the precedent really is those for which it has been successful are the much larger companies, again, to the point others have made. And so they're, the size of the companies themselves may be driving what draws people to this construct versus not.
Yeah, it's, I think it's interesting because you have different sort of structural things that, in each of these, and Spotify broke a lot of ground, around that. I think it was Palantir that had, they took the added step of setting more traditional IPO-like parameters, with theirs, where they had, a certain number of pre-IPO or pre-listing shareholders that would be locked up, very similar to kind of traditional 180-day lockup, and they allowed for a certain amount of, that some of those considerations are, again, like part of what also I think give in large institutional investors a little bit of pause, because they're sitting here saying, I just don't, I could say with some degree of certainty based on, an IPO order book and how I feel it's come together, how this stock should trade in the aftermarket. I don't know how a direct listing is going to trade. I don't know, and we were like having that conversation around like Coinbase and people like the variance of investor opinions around where that stock would be, a month after the listing was like here and here. And you don't see that a lot with, traditional IPO.
Mm-hmm. And on our market, it's not a listing because we're not an exchange, but a lot of the process of companies accessing the public market through us is through something akin to a direct listing, right? Where it's not about an initial capital raise, it's about what I was saying before. It's about a private offering that's seasoned and then under Rule 144 becomes publicly saleable. And because of that experience, part of what we think about, and I liked, let 1,000 flowers bloom or open every possible door, because there's multiple constituencies to think about. There's the company, certainly, and I think that's a lot of the focus that we all have. But there's also the investors, those initial investors, or those who might have become initial investors if they understood that there was going to be a public market at some point. So when an investor has participated in a private offering and that has seasoned, and they have an interest in selling that investment, or somebody else has an interest in buying, being able to have a public market facilitate those transactions is a huge piece of why people get involved in this to begin with. So I had a similar question to you as to why the direct listing process didn't take hold, but we do see it for companies, I think everybody said it, that don't necessarily have a capital raising need right now, but that can serve investors in a different way or serve their own interest in accessing the public markets through a process that's a little bit less arduous at that time in their development.
Well, sorry, go ahead. I was going to turn it back to you because I think
Perfect.
we could go on and on, but we do have a time limit in terms of...
I knew 90 minutes would go by in the blink of an eye. So here we are, almost at the end, and I thought it would be helpful if we concluded with a short round robin. We might only have time for one final question. So I suppose I will ask, we've discussed so many different topics on this stage. If I were to ask you the single most important thing that the SEC should be considering as it endeavors to modernize the IPO process and rethink the public company framework, what is that single most important change you would recommend, Dan?
All right. In keeping with what I've said before, I think looking to the company itself and the disclosure that company puts out, the metrics, the business of that company, as opposed to where it chooses to trade, whether that's on an exchange or OTC, but really starting to broaden the view of what a public company is, will, particularly for the smaller companies that we're focused on, will bring more of them into the fold and will allow investor access and the kind of growth that we're trying to facilitate.
Well, first, I'll just say the current rules that have been proposed take care of a lot. That's, I think, a big chunk, just to be clear on there. But generally, I think, as we look at like the alternative pathways, I think if a company's decision to go public, that shouldn't drive sort of their ongoing, the way they choose to go should probably be treated equally as far as the after basis. Sweet.
Good.
Yeah. So the single biggest transformative change I think we could see is something in the litigation reform space. Obviously, the commission has spoken on the ability to include mandatory arbitration provisions. I think that is fantastic. And to the extent we can go further than that, I think that really would drive more companies to go and stay public. I would say the other thing is I will put in a plug for durability here, because that's what we also hear from companies is if they don't have certainty that these things are going to last on the 5 or 10 year horizon, then that uncertainty can itself drive some of these decisions. So the more we can build that durability into the system on any of the proposals that may go final, I think that will be tremendous.
So I think just focusing, as you have already been doing, on sort of the cost-benefit analysis of being a public company going public. And so you've already done a lot in terms of taking the cost out of being public, kind of sort of focusing in on, cutting the burdens that aren't sort of like, driven by sort of giving investors material information, allow them to make an investment decision. So I think that continuing to focus on that is good. I think looking at the IPO process itself to see if you can kind of condense it, make it less burdensome too, I think will also sort of like, help things, and then we didn't really spend time on the litigation, but, I know the chairman has sort of like, he's like, I led the horse to water, nobody's drinking on the arbitration, but I think there are probably some other things perhaps that can be done, when you're working on the SK overhaul, on if there's going to be a materiality overlay. I mean, maybe there's some, meaningful sort of like moving of the needle on liability exposure that could be looked at there too.
I think if you want more small cap IPOs, take the guesswork out of the valuation discovery part of the exercise, modernize the testing the waters process, allow syndicate equity research analysts to be a more meaningful part of that, including pre-deal equity research and greater transparency of research analyst views into the market for both institutional and retail investors, immediately post-IPO.
Perfect. Well, thank you all so much for all of those thoughts. And really, on behalf of the SEC's Small Business Advocacy Office and the Division of Corporation Finance, we can't thank you enough for joining Ted and me on the stage today and sharing. There were some very bold ideas. So for sharing the bold ideas and all the candid feedback and potential regulatory solutions, you've given us truly a lot to think about as we move forward. Thank you very much.
Thank you. Yeah.